So the last 12 to 18 months have seen one of the most wildest rides in economic history, not only on the COVID front, but throughout financial markets and the economic markets. So today we're going to be looking forward to the second half of the 2021 financial year. So David, what do you see as the biggest risks to the economy and to the financial markets for the rest of this year? And then how do you see the rest of the year transpiring?
Yeah, look, there's always, as they say, equity markets climb a wall of worry. So there's always things to worry about. And in moments when you think there's absolutely nothing to worry about is when the markets are probably at their, at their highs. But look, the key worry at the moment is the US inflation picture. I mean, US inflation has leapt in the first few months of this year. I mean, even further than many anticipated. The hope is that dies down, like it is transitory. And what I mean by basically you've had demand run ahead of supply. So a lot of supply, international trade is still congested. Factories are still struggling to get back up to speed. And so you've had a lot of supply demand bottlenecks, which have pushed up certain prices. Used car prices, for example, in the US have gone up 40-odd% over the past year, which has been a big chunk to the underlying inflation measures. But provided that, if that doesn't die down, like if that persists, then bond yields will go up. The talk of the Federal Reserve in the US tightening interest rates will get more heated, and bond yields going up will be a threat to the equity market because valuations of the equity market are pretty high, but justified by bond yields staying low. So that's the worry, that if bond yields do go up because inflation hangs around longer than expected, that's going to put downward pressure on equity valuations, which could see the market come off. The positive news here is that economic growth, I mean, globally is certainly rebounding very strongly from COVID. COVID's obviously always still a risk, new variants that are immune to vaccines we wouldn't want to see. That's obviously a risk on the demand side. But assuming that holds up, assuming we don't get that, the growth outlook in the US in particular, but also globally, is very, very strong. Corporate earnings are very strong. So that's going to be supportive of the market. The risk is what happens with interest rates and valuations. So again, just on that point, I mean, I do think inflation will die down in the US. I think it is largely transitory. And as a result, bond yields will go up a little bit, but not by enough to derail the equity, ongoing, I guess, grind higher in equity prices.
Yeah, so obviously that's the most talked about point in the global financial markets at the moment. So the risk of inflation is there. We hit, I think it was 5% as the most recent figure of year-on-year inflation, which is the highest since 2008. So many in the market, the consensus view is that inflation is transitory. So I'm believing that you're also in that camp that we just see inflation for the next 12 to 18 months, and then it will go back down to the US Fed's target rate of 2 to 3% average inflation. But if we do see sustained inflation, which we are obviously, when building portfolios, you've got to consider that as a risk. And you've got to build portfolios around the view that inflation may actually be sustained, because there's heaps of factors. When I'm thinking about it, I think, okay, consensus views inflation is transitory. Markets are built for that. Markets will not react overly if inflation just dies off after 12 to 18 months. That's what they're expecting. But if I'm thinking about labor shortages, underinvestment in commodities, Biden's fiscal policy, which we haven't seen fiscal and monetary policy be together for that long. So what risk that will have on inflation moving forward. So what do you see as the factors that need to be together to see inflation for the longer term?
Yep.
And then what economic risk will longer term inflation have on the financial markets, and what will the resulting be?
Yeah. Look, I think when you think about inflation, there's two elements to it. Firstly, there's these, as I've said, the short run supply disruptions, the things like used car prices in the US going up, all hotels and restaurants putting up their prices at the same time after having had to slash their prices last year, lumber prices going up because of lumber shortages. So these are like transitory one-off, reopening things. The longer term inflation challenge is ultimately the labor market. This is why the US Federal Reserve and even in Australia, they don't see inflation being a sustained problem until we get clearly tight labor markets and wage inflation picking up. And so in the US, unemployment is still over 5%. When it gets to, sub 4% is usually rings alarm bells, because it means that the economy's, reached its end of its, spare capacity. So that is the longer term issue that will ultimately, cause inflation to pick up if we get a tight labor market and accelerating wages. Now, how the Fed responds to that is to slow the economy down. That's when you will get rate rises. If we get to that point, you get rate rises, you get the economy slowing down, and you'll probably get a deep correction, if not bear market, in the equity market at that point. Now, that is a normal type of cycle with inflation. Now, the other thing I'd point out is a lot of people, I guess the worst case scenario for markets is the sort of 1970s, where we had high and rising inflation for 10 years or more. Now, that really was supply shocks. I mean, you had OPEC, triple the price of oil overnight, and oil was obviously a bigger part of the global economy back in the 70s than it is today. So to get that really stubborn, apart from the labor market, the other type of thing that could cause inflation would be these sort of supply shocks. But to be honest, I don't see the repeat of the 1970s style supply shocks, likely. And oil is a smaller part of it's still important, but its importance to the global economy is not as great as it was, 50 years ago. Services are a lot more important. So, so I go back to central banks at the moment are relaxed about the inflation outlook until such time as we get clearly tighter labor markets than we've got at the moment, and signs that wages pressures are starting to accelerate, which could still be 2 to 3 years away.
Yeah. Okay. So you do obviously view that inflation is transitory. We've highlighted some of the risks. The risks are there for the markets.
Yep.
If inflation does turn out to be sustained, that is the biggest risk, obviously, for the markets in terms of an economic and financial market downturn. So please note, the information provided in this podcast is general in nature and should not be taken as personal financial advice.